Now, earlier we heard from Chad talking about global X's in investments in, or products following an S-curve and thematics. Monik's an active manager, obviously. So from the perspective of constructing a managed accounts portfolio, I mean, how do you think of combining active funds management managers with ETFs, you know, to capture these trends, right?
Yeah, I mean, look, we work across the whole opportunity set where the platforms will enable us to combine the two. A lot of the managed accounts may have like cost constraints and things like that, which do come into the picture with it. So for us, we can, and it's not quite true, but we can be vehicle agnostic, subject to it's playing the way we want it to play. It costs what it needs to cost. It provides the liquidity that we need. You know, and obviously we're aware of, you know, all the variables that go along with sort of relatively listed things and all the rest of it. But we do use them in combination. So typically we tend to use more sort of ETFs at the index level, purely just because of the cost basis. Some of the active sort of thematic sort of ETFs can be sometimes quite expensive. And they're expensive to get right in terms of the positioning set in the portfolio.
I mean, there would be a fair degree of overlap in some of those thematic ETFs with some of the broad-based active managers, right?
Yeah, and you have to be careful of that. So, I mean, that's what I say when you look at it and you look at like your core exposures or things like that. We tend to, like when I was talking about those trends, we actually look for those trends to be emerging regardless of whether it's a thematic play or not, but are they being picked up in portfolios, right? And that's like, if I just extend that a little bit, like one of the work, some of the work that we've been doing is around that sort of core equity sort of allocation. And you still get a lot of managers in that space that say, I don't understand tech. Well, we sit there and go, well, okay, tech's been in this market now for 20 plus years. So you can't be a core manager if you don't understand tech, right? So you have to understand it in some way. So we remove them from the portfolio, right?
Right. Okay, good. How do you sift through, you know, they're quite broad, those trends you talked about, obviously, but how do you sift through the trends to find companies, you know, that are good and bad to take advantage of that trend investing?
Yeah, good question, Nigel. So you're right; they were very broad, and I think I think the problem with thematic ETFs is people kind of identify the theme and just throw money at the whole theme and assume that all the stocks that are participating in that trend will go up. And research actually shows, if you go back last 100 years, that it's only 4 or 5% of all stocks that actually outperform over the long term. So you can't have every stock in a theme performing well, right? So I think the key there is, you know, as you said, themes are quite broad, and you've got to work out what are where the economic benefits definitely going to come through from, which is why we, you know, the broad themes are, you know, technology, demographics, decarbonisation, but you can't just make money out of that. We've only got one stock in decarbonisation. Love to have more. It's a fabulous theme, but there's only one stock that actually hits our metrics. So what you've got to do is you've got to there's a couple of steps involved. So first of all, you've got to identify, you know, the trend. You've got to work out how large that trend's going to be. Where are you on that trend cycle? Because if you're too early, then there's a risk, because there's a lot of money that's going into that trend very early, and there's a chance that a lot of companies won't make money. So you've got to be on that, on the exponential part of the S-curve, as they say, not at the early part when it's still forming. And then you've got to find the right company, and there you've got to use the classic skills of bottom-up investing. So you've got to look for good companies, which is what we do. So that's why I mentioned at the end, high levels of profitability, good cash flow, etc., and then you've got to know when to jump off it. And through that whole process, valuation is also an important consideration, because from time to time, markets get enthusiastic and they get overextended. So those are some of the tools that we use.